Hello everyone and welcome to CommBank View, Economics and Markets, where we unpack all the key issues that you need to know about that are affecting the markets and economies every single week. My name is Mandy Drury and I'm delighted to be your podcast host. So this week I'm very pleased to be able to be talking with Belinda Allen, who is the head of CommBank's Australian Economics. And Belinda, thank you so much for joining us once again. Always love talking with you. You've been predicting that the Australian economy is going to slow down for some time. Certainly seems to be coming true. Tell us what you think the drivers are now, though, given that the Iran shock seems to be fading.
We've certainly seen a shift in what's going to cause the Australian economy to slow. If we think back 4 months at the height of the Iran war, we certainly thought higher oil prices, higher petrol prices, weak sentiment would cause the Australian economy to slow, so households would be pulling back. We certainly think now, in the middle of July, that's still going to happen, but it's really the housing market that's going to create that slowdown in the Australian economy rather than higher oil prices. So the drivers have shifted, but the overall result will still be a slower economy.
It certainly seems like post-budget, the housing market is rapidly deteriorating. And of course, you've made the point before that it was already on the ropes given that we'd had those couple of interest rate hikes pre-budget. So how much now do you think the Australian economy will slow as a result of housing, and when might the bottom for the housing market be?
So many different issues to unpack with the housing market. So definitely that slowing in momentum picked up in late 2025. But now in July, we've certainly seen in the last couple months that slowdown accelerate across all capital cities at the moment. Just looking at the daily data this morning, it looks like Adelaide is turned negative, Brisbane's very close, Perth's holding up, and of course Sydney, where we're from at the moment, we have seen falls in recent months. So sentiment, as we've known for a number of years now, is a really key driver for Australia's housing market. But we've had those 3 interest rate hikes, as you spoke about before, and the budget tax changes. So it's those combination of events at the moment that have seen the housing market pull back. And we've seen in past cycles that does impact the consumer through what economists like me call the wealth effect. So we think that's going to play out for the rest of this year. Into 2027, we think 2 interest rate cuts by the Reserve Bank of Australia here will help stabilise the housing market and see the Australian economy pick up through late 2027. But if we just think through the numbers at the moment, if we go at the end of 2025, the Australian economy was growing by 2.5%. End of 2026, we're thinking 1.5%. And by the time we get back to the late 2027, we think growth's going to improve to about 2%. Mm-hmm. So a lot of that's housing, a lot of that's the consumer. But next year, it will certainly start to see some more structural factors take over the Australian economy.
So, okay, so you're suggesting that come 2027, that's when we might start to see some interest rate cuts come through from the RBA. So could that be the circuit breaker for the housing market, you think?
We do. And when we look at what is really drivers of the Australian housing market over time, the interest rate cycle is certainly up there. And then we have fundamentals. So how much supply of housing is out there? So what's the new builds coming through? What's the demand? So what population growth's doing? That's still a mismatch. So we think fundamentally there are reasons why the Australian housing market should lift through 2027, but generally the catalyst has been improvements in sentiment, and interest rate cuts play a really big role in that.
People often say don't underestimate the power of the Australian consumer. So, you've mentioned the consumer and the various factors that could be putting pressure on them a few times now. So do you think that they're going to really slam on the brakes, or to a certain degree will they keep on spending through this downturn?
A little bit of both.
Mm-hmm.
So generally when we see home prices soften, there's the wealth effect. So people are less likely to buy a new car. They may be eyeing off that new electric vehicle at the moment. They might not do that anymore and might not buy that new jacket that's been on sale, or a new TV, a new lounge. They're the types of items that generally when home prices are softer, people pull back on. So we are expecting to see some of that come through. What we see in our own data here at CBA at the moment is signs of that. End of financial year sales that are on at the moment. Not sure if you've been to the shops lately, but there's certainly...
I'm heading off straight after this, actually,
okay.
Belinda.
Very good. Just walk straight up to Pitt Street there. There's obviously a lot of sales going on. And what we see in our data is they're not quite as popular as what they were this time last year. So there are signs the consumer's pulling back. And we know it's around half of the Australian economy. So if you and I aren't spending as much, that is going to slow the Australian economy through the rest of this year. A lot, though, will depend if we're going to tip into our savings.
Mm-hmm.
So when we look at savings accounts across Australia at the moment, they're generally healthy in an aggregate sense. So households have the ability to dip in if they choose, but given sentiment has been quite soft, home prices are falling, we don't think that's going to happen to a large degree, but that is something we are watching very closely.
Yeah, so when you look around the Australian economy and you try to find some of the mitigating factors, you know, the tailwinds that might sort of offset some of the prevailing forces that you're talking about to slow the Australian economy down, to what degree can the data centre build out and the ongoing, amazingly defying all forecasts of doom and gloom, the AI boom continues? Will that be able to help offset the housing-led slowdown?
Not fully. So we've done a lot of work on this, and Lulu in the team, who's coming on, I think, to do the week ahead later on, has done a whole bunch of work looking at the data centre pipeline, and it's large. There's no doubt about that. You just have to open the newspaper this morning. Actually, we're just remarking before we just opened the paper this morning, and once again, that's news headlines. Mm-hmm. Data centres, offshore AI companies looking at buying up and building out data centres here in Australia. So we do think that's going to boost growth over the next few years. There will be constraints though. So energy supply is one of them. We know it demands a lot of resources in terms of energy capacity, water, a lot more debate around the social license for data centres as well at the moment. And it does take some time to build out. So while we're optimistic, we do think there'll be constraints for the data centre build out. So it will help Australia's economy, but it's not going to fully make up for that slowdown in the consumer. 2027, 2028 could be a different story as the whole of the Australian economy improves. So we do think that's going to help, but we also import a lot of it. Mm-hmm. So all the chips that come in to allow those data centres to do the compute, to train the AI models, that's all imported. So the spillovers to the Australian economy are lower than, say, what you're seeing in the US. And I know Joe Capurso is going to be on later to talk about the AI boom. It's a very different story in Australia than what you're seeing in the US.
So it's not, in your opinion, going to be a case of a data centre boom and then bust, in that we're maybe overbuilding right now in the rush to have data centres?
That's not our view. So we think that the pipeline, yes, it's large, but there's going to be constraints in building it out. And we know there's a lot of demand for the compute at the moment.
Talking of constraints, how much do you feel that public sector spending, which in the past has, you know, often smoothed out some of the ripples and ruffles that we've seen in the Australian economy, how much is public sector spending this time round also facing some constraints and limitations?
It's interesting. I would say it's moving from a main actor role to a supporting actor role in the Australian economy. So through 2022 to 2024, it was the starring actor. It was the NDIS build out, a lot of the state public sector transport projects were coming online. That was really the growth driver of the Australian economy. Whereas over the next few years, we think it's still going to be there, but not the main driver. So
Why is that?
It's just the private sectors look better. Mm-hmm. So the consumer, yes, now it's slowing, but through 2025, the consumer was strong. Business investment through the data centre build out is really going to help drive Australia's growth. And we're not seeing at the moment a big lift in spending. It's still there, but it's not as strong as a growth factor as what we've seen. So we know the government's trying to push through cuts to the NDIS program. So that's going to, I guess, be more constrained going forward. And that's really the main reason why we don't think it's going to kind of shoot the lights out like it has the last few years.
Okay, so let me just try and get this straight. You're saying that public sector spending could move from a starring role to a supporting role. We've got the housing market, which is slowing down. We've got the consumer, which is being, you know, has got a few headwinds facing them as well. And yet the RBA is probably sitting there thinking, well, our hands are tied because inflation is really sticky. In a normal situation, facing all the things that we've just mentioned, you'd say, okay, it might be time to cut interest rates. Is the RBA not in a position to be able to do that?
Not yet. So We don't think the RBA is going to be hiking again. We've held that view now for quite a few months after that last May interest rate hike. They're still cautious though. I think they remember how hard it was to get inflation down last time it got too high. So they don't want to declare victory too early this time around. So no more interest rate hikes. I think what they'll also be watching quite closely, though, is the labour market. And there's just more signs recently that we are starting to see some softness come through. Actually, in our forecast update, we did lift our peak unemployment rate forecast to 4.8%. So we're currently at 4.4%. So we don't think they'll be as strong as employment growth as what we've seen in the past in the Australian economy. So if you think about what the RBA is trying to do, they're trying to bring inflation back down to 2.5% and not let the unemployment rate get too high. So we think based on that, those 2 interest rate cuts next year make sense as the RBA tries to achieve both their objectives.
So AI is a double-edged sword, isn't it? You know, we've just talked about the benefits of AI and the data centre build out to the economy, and yet there's also the labour market side of AI, right? So do you think that structurally we might be in for higher unemployment rates down the line because AI is replacing people?
Probably not yet. So we certainly think the softness we see coming through the labour market is not driven by AI at the moment. It's just driven by generally softer employment growth in the private sector and the public sector. So we saw this rapid build out in jobs in what would say education, healthcare, and the public administration sector as well. That's probably done now. It'll be a slower rate of growth going forward. Whereas the private sector, certainly in the near term with slower growth, won't be hiring as much. But beyond that, we aren't seeing too much impact, certainly at the fringes in particular occupations and tasks, but not enough at the moment to meaningfully change the labour market.
Where are we sitting in terms of insolvencies? And because, you know, you open the newspaper, yet another retailer has gone under, yet another construction company has gone under. What's your forecast there?
It's certainly an area that we're watching. So we know businesses at the moment, particularly given the Iran war and what we've seen in terms of construction costs or high oil prices for that period of time, have put a lot of pressure on profit margins in businesses. So business confidence has been at very low levels. Business conditions have softening. So we are keeping a very watchful outlook for that part of the Australian economy. But really, there hasn't been too much movement to date.
Wonderful. It's been really great to talk with you, as always. Belinda Allen, Head of Australian Economics. So I hope you've enjoyed this robust conversation with Belinda about what's happening here at home in the Australian economy. But let's go a little further afield, shall we, and take a look at what's happening on the global stage. And for that, I'm delighted to be joined by Joe Capurso, Head of Foreign Exchange, International and Geoeconomics, or FIG, Research. Joe, thank you so much for joining us today.
It's great to be back again.
You know, there is one tailwind out there for the Aussie economy that we didn't talk about with Belinda, and that is, of course, that oil prices have come way back down now to pre-Iran war levels since the signing of the MOU between the US and Iran. So that's not just good for Aussie consumers, it's good for the global economy too, isn't it?
It certainly is, and it was really unexpected, I have to say. We thought that oil prices would stay elevated for longer, but they've come back down, as you say, back down to pre-war levels very fast. But we should point out that while that is good for households and businesses and, dare I say, central banks, and I think an important reason why gas prices are elevated is because of the permanent damage done to Qatari gas fields. It will take 3 to 5 years to repair Qatari gas fields, and so I think that's why Europe is going to be in the economic slow lane for quite some time, because they've got particular exposure to gas.
Apart from Europe, where else in the world has particular exposure to these elevated gas prices?
Oh, it's mainly in Europe. Unfortunately, Europe was in the unfortunate situation of moving from dependence on Russian gas. They moved that dependence to elsewhere in Europe and to the Middle East. And then, of course, you had the war that's cut off quite a bit of their foreign gas supplies.
You know, the problem is that what we've certainly seen from the Iran war, and Iran has shown us that it is both easy and cheap to be able to choke and close down a major maritime pathway. Do you think that we're going to start see other governments who are on these maritime really, really important passages to extract concessions from those who are trying to pass through And this is obviously going to be something that is going to cause potential problems, if not wars, down the line.
Yeah, it's the major geopolitical lesson of the war has been how easy and quick and, dare I say, cheap it is for Iran to close down the Strait of Hormuz. Now, the Strait of Hormuz is not by a long shot the largest global maritime choke point in the world. There are other much larger ones. So they have demonstrated that it's easy to do. Now, the negotiations between Iran and the US, if what comes out of that is that Iran can charge some sort of fee for transit, then that will be a precedent that other countries will look at. So geography is now seen as an asset that you can monetize. And there's a real life example now. So the Indonesia's finance minister, for example, said just a month or two ago that perhaps Indonesia, Malaysia and Singapore should charge a fee for ships going through the Straits of Malacca. And the number of ships that go through the Straits of Malacca are about 3 times more than the number of ships going through the Strait of Hormuz. And in fact, a lot of the ships that go through the Straits of Hormuz carrying oil and gas also go through the Straits of Malacca. So it's a major potential problem for countries in our part of the world, north of Australia, East Asia.
And if we try and extract out what exactly that problem entails, am I right in thinking that it would make both insurance and also the cost of shipping go up for everybody around the world, and therefore all the goods that we have to import here in Australia that come by ship will be more expensive?
Exactly right. So you can see how very quickly it becomes an inflation problem. So look, it's probably too early to tell whether Iran is going to be charging fees. We think there's a very good chance of that, and that could spread to other choke points too.
We were talking a moment ago about what's happening with the data centre build out here in Australia and also AI spending. And you've been doing a lot of research on AI, particularly in the United States. Just how big is that capital spending still? And what are the implications for global economies from that?
It's extraordinarily large. It is so big that it is moving the dial on the US economy. And of course, the US economy is the world's largest economy. So this year, just the 5 hyperscalers are going to spend just something short of $800 billion US dollars, which is about 85% above what they spent last year. And next year, they will spend close to $1 trillion US dollars. So it's going to add...
It's eye-watering, isn't it?
It is. These are massive numbers. It will add a 0.5 percentage point to US economic growth this year. On top of that, you can add another 1/3 to a 0.5 percentage point of economic growth from the tax cuts in the US. So the US is going to have a very good year this year. We think it will grow at a bit under 3% this year, which is very fast for a mature, large economy like the US. But there are these very large spillovers from US AI spending to other countries. And in particular, East Asia, Canada, and Mexico are major beneficiaries of selling hardware to the United States as part of the AI supply chain. So the small economies like Mexico, Vietnam, Malaysia, Korea, Taiwan, they are major beneficiaries of this US AI capital spending. But even the big economies like Japan and China are going to be beneficiaries as well. So the US AI capital spending is not just about the equity market that we read about every day. It's also about economic growth in the US and big spillovers to the rest of the world.
But it's important that you mentioned the equity market, because how concerned are we still about not just overvaluation in the AI-related listed companies, but also overspending, overcapitalizing? And I asked Belinda a similar question with regards to the data centre build-out.
Yeah, look, that's an excellent question. I get asked that question all the time by clients. Look, I'm no equity analyst, so I won't go into whether they're overvalued or not. But what I will say is that the AI capital spending is real. The infrastructure spending that is needed to use the AI is real. All the hardware and the electrical items that you need to run and build the data centers, all of that is real. So AI is real. But what makes it different to many other spend ups is that it is a general purpose technology that all industries are going to embed in their processes, and it's going to be with us for a very long time. So we've got historical analogies like the general purpose technology of electrification of last century, or the prior century to that, railways. So they were very big booms. There were definitely excesses. It wouldn't surprise me if we get some mixture of boom and excess this time round as well. But at the end of it, we're still going to have the technology. It's still going to be general purpose and be used everywhere.
And we certainly can't talk about AI or a global technological race without bringing up China, of course, which has been somewhat in competition with the United States. And the Chinese economy is incredibly important to the Australian economy. Where do you think the Chinese economy is sitting right now, and how has it coped with the Middle Eastern war?
So there has been a few really notable developments here. Number one, China's coped with cutting off Middle Eastern oil extraordinarily well. So they had very large reserves they could draw down on. They also have cut their exports of refined fuels to keep it internally. So that were two very important ways that they could get through this. But there's also another element here, and that is China is a supplier to the US and other countries of AI tech, but the hardware. They're part of the supply chain.
Which they could cut off as leverage anytime they wanted. Belinda mentioned the issue of constraints if we're importing a lot of the really key components of this AI build-out.
That's right. This goes back to geopolitics again, that economic dependency can be used as a geopolitical tool. And of course, Australia's faced that several times in recent years from China, for example. But the other thing that hasn't changed in China is that it's still a two-speed economy. So you've got exports of AI, high-tech, green tech in particular, like EVs, very strong, really dragging the Chinese economy along. And then you've got the consumer side, very weak, low consumer confidence, housing downturn in its fifth year. So
with no end in sight?
Exactly right. Well, you've got China's population is falling dramatically. So it's hard to see how you're going to get a big turnaround in home building anytime the next few years. So that you still got that two-track economy in China. We think overall China's economy will grow about 4.5% this year, which would be
by
great.
most economy standards.
It'd be great for Australia.
It's not shabby.
But for China, it's a long way from the 8 to 10% that we saw a decade or so ago.
It certainly is all relative, isn't it?
Exactly.
Well, China's manufacturing prowess has been a competitive threat to not just the US and elsewhere, but Europe.
Yeah.
Quite strongly, actually. And Europe's economy has been stuck in the slow lane for some time now. And they've also got the double whammy on the geopolitical front of the security threat from Russia. When is Europe going to get out of the slow lane?
Both of those issues, this Russian security threat and the China economic threat, they are going to require a lot of money by Europe to meet those threats. Now, just overnight, in fact, we found out that the German Parliament, Bundestag, has passed a budget to significantly increase defence spending in Germany from less than 100 billion last year to 150 billion euro next year and 200 billion a year by 2030. Now, that is going to give a significant kick along to the European economy, the German economy in particular, and that will help the Eurozone economy to slowly get out of its slow rut that it's in. The Chinese economic threat is also very real, in particular in transport equipment such as cars and trucks, and that's been the defining industry for Germany. So it's going to require a lot of retooling by European manufacturers to be able to meet the Chinese competitive threat.
Do they retool or do they throw in the towel?
They have to retool, I think. I don't think they've got much choice. It's going to cost a lot of money to do that. What is not well understood is that China's value add-in is now so significant that its exports are getting very similar to European exports. Whereas for a long time, people thought of China as just being low value-added clothes and compiling electronics and the like. China's moved way beyond that. They are at the cutting edge of a lot of high tech, particularly green tech, and they are a real threat in the car transport space as well.
I bought a Chinese car here in Australia
Okay.
5 years ago,
Yes.
when it was still quite rare to see Chinese cars on the streets. Now they're everywhere.
Exactly right. They're
I was a trailblazer.
You certainly were. So Chinese EVs are outselling like American EVs like Teslas in Australia now. And I think we're only just getting started. They're going to make inroads into the EV market in all countries. And that's yet another geopolitical lesson from the war, is that countries now want to decarbonise their transport fleet even more so they can reduce their dependencies on liquid fuels like petrol and diesel.
That's a good lesson that we learned from China, wasn't it?
It certainly was.
Thank you so much for joining us today. It's been a great conversation. Joe Capurso.
Thank you.
Before we let you go, let's take a look at the week ahead in the markets with Lucinda Jerrigan, Associate Economist at CommBank. Lulu, thank you so much for stepping by the podcast studio. We've got a main watch point this week, which is across the Tasman Sea, and that's the RBNZ, the Reserve Bank of New Zealand. What are they up to?
Yes, so the Reserve Bank of New Zealand meets later today. Our Kiwi colleagues at ASB accept the RBNZ to keep the official cash rate on hold at 2.25%. But it's expected to be a very close call, with a split decision expected. ASB had previously expected a hike today, but recent developments have prompted them to shift their thinking. And there's really two key reasons for this. The first is that US-Iran developments, while still fragile, have taken some heat out of that inflation story. So we've seen oil prices come down, and with that, a reduced risk that higher fuel costs breed into broader price and wage pressures. The second is that the Internal Monetary Policy Committee have probably not seen enough evidence to shift to vote for a hike today. So the data since the May meeting has been pretty light and mixed. And there's only 8 weeks till their next meeting in September, giving them time to wait and watch the data flow.
Elsewhere offshore, we've also got the Federal Reserve minutes. What in particular are we watching for there?
Yeah, so we'll get those meeting minutes tomorrow. Markets will be looking to see if Chair Walsh's hawkish comments in the post-meeting press conference come through in those minutes. Tomorrow we'll also get inflation figures out of China, followed by labour market data in Canada on Friday.
And back at home, we've got no major ABS releases, but we've got the CommBank wage and labour insights, and we've also got CommBank household spending insights coming up.
That's exactly right. So on Friday, we'll release our CommBank Wage and Labour Insights. Now, this series uses CommBank customer data to provide a timely read on wages and jobs in Australia. In May, we saw wages growth and jobs added hold steady, but we've seen some softening in the official data recently. So it'll be interesting to see if that comes through in our data. We'll release our CommBank household spending insights. Last month, we saw household spending grow only modestly after a sharp pullback in April. We also saw the annual pace of growth continue to ease from those strong growth rates we saw to end 2025. The June figures will be really interesting to see if this slowdown has continued. They'll also capture the end of financial year sales. Now, I don't know about you, Mandy, and our listeners, but my inbox has been flooded with discounts across a range of different brands.
They're still coming, and it's already in the new financial year.
Exactly right. So the real question is, have households taken advantage of those deals, or is higher interest rates and inflation keeping people more cautious?
Excellent stuff. Thank you so much for joining us with that look ahead. Lucinda Jerrigan joining us there from
Mandy.
CommBank. And thank you for joining us for this episode. Make sure that you do join us on CommBank View every single week. My name is Mandy Drury, and have a great day.